Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about HARROW Inc. Annual Report. HARROW Inc., an eye care pharmaceutical company, offers a wide range of ophthalmic products for various eye conditions. The company's portfolio includes compounded medications such as Imprimis RX, which provides customized treatments for patients with specific needs. In addition to Imprimis RX, HARROW Inc. offers several other products that cater to different eye conditions. These include IHEZO and ophthalmic solutions like IOPIDINE, VEVYE, and ZERVIATE, which are used to treat various eye problems such as pain, inflammation, and bacterial conjunctivitis. The company also provides MAXITROL eye drops for the treatment of dry eyes and other conditions. Furthermore, HARROW Inc. offers non-steroidal and anti-inflammatory eye drops like ILEVRO and NEVANAC, which are used to manage pain and inflammation associated with cataract surgery. In addition to these products, HARROW Inc. also offers steroid eye drops such as MAXIDEX and FLAREX for the treatment of inflammatory conditions. The company's portfolio also includes TRISNC, a steroid injection used for the treatment of ophthalmic diseases and visualization during vitrectomy. The company's product line also includes NATACYN, an antifungal drug used to treat fungal blepharitis, conjunctivitis, and keratitis. Other notable products include TOBRADEX ST, VERKAZIA, NEVANAC, and FRSHKOTE preservative-free lubricant eye drops. Overall, HARROW Inc.'s diverse portfolio of ophthalmic products provides a comprehensive solution for various eye conditions, making it a leading player in the eye care pharmaceutical industry. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to increase significantly in the past year. The stock price of HARROW Inc. has increased significantly in the past year due to several factors. One major reason is the company's strong financial performance. A robust revenue growth and improved profitability have led to an increase in investor confidence, causing the stock price to rise. Additionally, the company's innovative products and services have been well received by customers, resulting in a significant increase in demand. Another factor contributing to the surge in HARROW Inc.'s stock price is its strategic partnerships and collaborations with other industry leaders. These partnerships have expanded the company's reach and capabilities, making it an attractive investment opportunity for investors. Furthermore, the company's commitment to sustainability and social responsibility has also resonated with environmentally conscious investors, who are increasingly looking for companies that align with their values. The overall market trend and economic conditions have also played a role in HARROW Inc.'s stock price increase. A growing economy and low interest rates have created a favorable environment for stocks to rise, while the company's strong fundamentals have made it an attractive investment option. As a result, investors have been flocking to HARROW Inc.'s stock, driving up its price significantly over the past year. In conclusion, the combination of strong financial performance, innovative products and services, strategic partnerships, commitment to sustainability, and favorable market conditions has contributed to the significant increase in HARROW Inc.'s stock price over the past year. HARROW Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. HARROW Inc. trades at a higher price-to-book ratio of 27.84 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that, the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The analysis of net income and profit margins reveals a mixed picture. Initially, on page 9, it was noted that net income decreased due to increased competition from generics and biosimilars and reduced demand for existing products. However, by page 19, the company's future profitability was uncertain, with projections indicating potential operating losses. By page 29, net income had decreased further due to decreased reimbursement rates, increased rebates and discounts, and shifting costs to manufacturers. This trend continued on page 32, where net income decreased due to increased competition from branded and generic drug companies. On the other hand, pages 31 and 59 showed no change in net income. Profit margins also experienced fluctuations. On page 9, profit margins decreased due to increased competition and reduced demand for existing products. By page 29, they had decreased further due to pricing pressures from payers and government policies. The trend continued on page 31, where profit margins decreased due to government guidelines and recommendations reducing the use of branded products. The analysis suggests that net income and profit margins were negatively affected by various factors, including increased competition, reduced demand for existing products, pricing pressures, and regulatory changes. However, there is no clear indication of a consistent trend or pattern in these changes across all pages. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the net cash provided by operating activities, which stood at $123,119,000 in 2025. This significant amount of positive operating cash flow suggests that the company is efficiently managing its day-to-day business and generating sufficient revenue to cover its expenses. The presence of a substantial positive operating cash flow is a crucial sign of a company's financial health. It indicates that the company has enough liquidity to meet its short-term obligations, invest in growth initiatives, and reward shareholders through dividends or share buybacks. In this case, the company's ability to generate $123 million in net cash from operating activities demonstrates its strong operational performance and financial stability. Overall, the data suggests that the company is successfully generating positive operating cash flow, which is a vital component of its overall financial health. This trend bodes well for the company's future prospects and provides confidence in its ability to continue delivering value to stakeholders. The company's debt level has experienced fluctuations over the years. Initially, total long-term debt increased from $219,539,000 to $243,184,000. However, this increase was offset by the repayment and prepayment of outstanding borrowings, including the Oaktree Loan, 2026 notes, and 2027 notes, which resulted in a decrease in debt level. Despite these changes, notes payable net still increased from $219,539,000 to $243,184,000. Regarding interest expenses, there is no clear indication of significant changes throughout the document. Interest expenses did increase from $22,786,000 in 2024 to $24,180,000 in 2025. But this was followed by a decrease of $394,000 from 2023 to 2024 and an increase of $2,394,000 from 2024 to 2025. Additionally, the company incurred a loss on debt extinguishment of $7,750,000 in 2025 due to interest expense related to specific loans. Overall, these changes suggest that the company's debt level and interest expenses have not undergone significant transformations. The performance of various segments and regions within the company has been mixed. On the positive side, the ophthalmology segment performed well, as did the U.S. market, which saw significant growth. The branded segment also experienced a notable increase in revenue, rising from $50 million to over $195 million between 2023 and 2025. In contrast, certain regions struggled with poor performance. France, Belgium, and Spain were identified as areas where only a few products were manufactured, suggesting limited market presence or production capacity. Furthermore, foreign jurisdictions faced significant challenges due to regulatory hurdles and compliance issues, leading to underwhelming results. The Imprimis RX segment also saw a decline in revenue between 2024 and 2025, indicating a need for improvement in this area. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the most notable one is the recent purchase of BYOOVIZ, a product that was acquired in an unspecified manner. This acquisition suggests that the company is expanding its portfolio by adding new products. On the other hand, the company has also engaged in several divestitures. One significant move was the out-licensing of Canadian rights for various products to Apotex Inc. in February 2024. This decision likely aimed at streamlining operations and focusing on core markets. Furthermore, the company surrendered 2 licenses, a $503 billion out-of-state outsourcing facility license and a $503A out-of-state compounding pharmacy license, both effective as of February 1, 2026. These divestitures indicate that the company is reevaluating its operational scope and eliminating non-core activities. The company's financial strategy has been focused on reducing its debt and increasing shareholder value. One way it has achieved this is by buying back shares through debt extinguishment. This process involves using the proceeds from the repayment of certain debts to repurchase outstanding shares. In 2026, the company used $1,808,000 from the HARROW notes to buy back shares. Additionally, in 2027, it utilized $2,524,000 from the HARROW notes for the same purpose. Furthermore, a significant amount of $3,418,000 was allocated from the Oaktree loan towards share repurchases. It is worth noting that despite these efforts to increase shareholder value through share buybacks, the company has not paid dividends to its shareholders. There are significant concerns about inventory buildup or supply chain disruption. The potential for power shortages, telecommunications failures, natural disasters, and regulatory actions can lead to supply chain disruptions, page 23. Additionally, macroeconomic and geopolitical developments can also cause supply chain disruptions, page 26. The removal of bulk drug substances from the 503 billion bulks list could disrupt operations, revenues, and cash flows, page 27. Furthermore, advance payments of duties, delays at ports of entry, reduced availability of materials or components, supplier disruptions, increased working capital requirements, and disruption in global supply chains can all contribute to inventory buildup, page 31. The reliance on third-party manufacturers also poses a risk of supply chain disruption due to potential delays or failures in obtaining manufacturing approval from regulatory authorities, page 41. Moreover, manufacturing issues with contract manufacturers can lead to significant interruptions in the supply of drug candidates and lost sales, page 42. Finally, higher expected product returns are associated with the timing of lot expirations and wholesaler inventory levels, page 60. These concerns highlight the potential risks and challenges facing companies in managing their inventory and supply chains. That concludes the financial summary for HARROW Inc. Feel free to comment below, and I will be happy to answer them when possible.